This is AJ, and what I'm doing here is a presentation, as you can probably see on your screen, what to avoid during a market drop to generate some serious investment income. And that's exactly what I have been doing over the past weeks with the latest. And so, as I mentioned earlier, this is more of a instructive presentation and less of pitching you. So please have, as I mentioned earlier, a piece of paper and or pen or pencil. Actually, you're going to need one or the other, pen or pencil. Pen if you're feeling confident. Let's get right into it. So I got some facts for you. Of course, what's happening in the world right now with everybody getting sick and or a lot of people passing away and stuff, that really just sucks, right? But what's happening in the markets, especially with the Fed buying all kinds of junk bonds, propping things up, if it played right now, if played correctly right now, it can set you up for months, if not years to come. And let me tell you that a lot of us are being forced to take time off right now. And this is the perfect time to get off our rusty dusties and use this gift that we've been given to profit, not to lose. So there's a couple of things going on right now. And let's see if we can't make these lemons into some lemonade. So here are some trading rules I'd like you to jot down that you should live by across the board, whether you're trading stocks, commodities, Forex, options like I am, futures, anything like that, right? Number one is always adjust any of your positions in times of peace, not in times of war. I think I got that from Craig, the linebacker option trader. A lot of people come to me and they're asking me, hey, AJ, I've got this position going against me. What do I do to adjust it? Well, that's what I call a time of war. If your position has already turned around against you, the best thing to do probably is to liquidate the position, take the losses that you've incurred, and then look for something better. When you're in a time of peace, when the position is growing your way, that's the time to put on, married protective options, some collars, things like that, because that's a time of peace, and that's when we like to adjust things. So that's one of the things that you want to avoid. You want to avoid trying to adjust positions when they go against you. I know that sounds counterintuitive, but the adjustments need to be put on before the position is going against you. So please jot that down. One of the things that can really be an SOB is fear of missing out, right? And so we jump into a lot of things because we're afraid. In fact, a lot of studies have been done about what is the thing that people are number one afraid of. And you might say, well, I'm afraid of death. No, it turns out that's only number 3 on the list. In fact, number 2 on the list would be fear of being embarrassed in public. But number 1 is fear of missing out, right? Fear that somebody else is doing something that you could be doing just as well, right? But watch out when it comes to investing, right? Because investing, when you have a fear like that, it could really turn against you. In fact, what we like to do to make sure that FOMO doesn't get into our lives when we do investing is we like to plan our trades and then trade our plans. In fact, that was something that came around. It's taken right from in the early 1990s. You might remember all these companies that were saying they were ISO 9000 certified or 9001 certified, which basically was write down what you're going to do and then do what you wrote down. Well, in this case, we like to plan out our trades and we like to plan out the worst case scenario. Write that down. Plan out the worst case scenario of your trade and then trade what you wrote down, right? When you have the worst case scenario planned out, you can take from that some price targets so that you can do better than the worst case scenario. And you can take from that the maximum risk of the trade and limit your risks. This is the second most common error that investors make. You ready? It's that we first must recognize patterns. We call that pattern recognition. And then we use the tools that we have to profit from those patterns. That's called pattern utilization. I had somebody, in fact, if I had a nickel for all the times I've heard this exact story, and this may resemble something for some of you out there, but the story goes something like this. Hey, AJ, I learned how to do, and you fill in the option trading strategy there. I learned how to do credit spreads, or I learned how to do covered put writing, or I learned how to do cash secured put writing, or whatever it might be. I learned how to do long calls and long puts. And I was doing really well every month, making double-digit returns. And then something happened on the 10th month where not only did I lose all the gains I made in the first 9 months, but I lost half my portfolio. And this is because, in part, this second most common error that investors make, which is they take a strategy, we call that a pattern utilization tool where I come from, and they try to apply it across the board to every situation, instead of being aware of the situation. In fact, I pride myself and I pride my folks. I tell them to be pattern recognition specialists first and then pattern utilization experts second. I pride myself on being able to notice every pattern out there. In fact, I can't even leave my home without looking at the electrical meter on the side of the house, because I know exactly when my wife has her hair dryer running. I know when our Bitcoin servers have gone offline. I know just about everything that goes on. And all I do is I look at all the different meters in the house, right? And I'm constantly doing that, and it drives my wife crazy, because I'll come in and I'll say, excuse me, did you turn on the AC unit? You know, it's still kind of cool outside. So I know when patterns have changed. I think that's what makes me a very good investor. I've been doing trading since 1997. You have to be very good at recognizing the patterns, because every pattern deserves a different type of trading strategy. If you're trading stocks, commodities, or Forex, foreign exchange currencies, you probably have, a handful of 3 or 4 strategies you can use. You can go long, or you can go short, or you could do nothing, right? If you're getting into more of the derivatives like I do, options or futures, well, then you've got, last time some mathematicians looked at it, 27 different ways to profit from the patterns. But if you apply one of these strategies to the patterns that don't deserve it, like for instance, if the market starts dropping or if the market starts going into a trend, the last thing you want to do is a credit spread, right? You'll lose everything. The credit spread is designed, it's a range-bound strategy. It's designed for when the market goes neutral. So keep that in mind. The fastest way to suffer trading losses is to reverse these 2 steps. And maybe you might also be interested in the idea of, hey, you don't want to just go and try to learn a single strategy. Maybe learn a family of strategies, because you want to be able to apply those strategies to any pattern that comes on by. Now, I said this was the second most common error investors make. Do you want to know what the first one is? The first most common error that investors make is that they only invest the amount specified when they take the max allowable risk to our portfolio and they divide it by the max trade risk. This is actually a mathematical formula. Portfolio sizing. In fact, I'm almost sure that I can actually draw on this screen, and I'm going to do that with my pencil right here. If you take your position sizing, let me see if I can get a better pencil than even that. Maybe not. That's okay. I'm going to clear my drawings, and I'm going to use a different tool. There we go. If you take your position sizing, that's always going to be equal to the max allowable risk to your portfolio divided by the max trade risks. that trade risk that we determined by figuring out what the worst case scenario of the trade might be. What if we get stopped out, or whatever that might be? That's your max trade risk, your max allowable risk to your portfolio. You divide one by the other, you're going to get your position sizing. Going back to that story that I've heard over and over and over again, why did that person after the 10th month not only lose the gains they made in the first 9 months, but also lose half their portfolio? I asked them that. I said, how did you do that? How did you lose all that money? What was your trade risk? What was your risk management strategy? And their answer was, well, in the beginning, I didn't understand credit spreads very well, so I didn't put very much money into the position. But then as I got confident, as the months rolled on, I put more and more. Until that 10th month, I was putting a good portion of my portfolio. Well, there's your mistake right there. This is the first most common error that investors make, and that is they take their confidence level and use that as their I am just so flabbergasted even saying the words. They use it as the way to determine position sizing. Your confidence level and your strategies has nothing to do with how much you should invest in a position. Nor, here's another scenario I get, I had some bills that were coming due and I needed to make sure that I could cover the rent when it was due. So I invested enough to make my rent payment. Your rent payment has nothing to do with how much you should invest in a particular trade. Another one, and this is the final one I'll give you, is I had been making some losses and I needed to recover those losses. So I invested enough to recover those losses. You'll notice that all of those three excuses for position sizing, that they're all very self-driven. I was confident. I had some bills due. I wanted to recover some losses. The market doesn't care about me or you or anybody individually. The market doesn't care if your rent payment is due or how confident you are. The only thing the market cares about is the amount of risk in the trade and the amount of risk you'd like to see in your portfolio in the worst case scenario. We usually say that our max allowable risk to our portfolio should be no more than 4%, sometimes even less than that. That means you'd have to do 25 trades in a row in order to wipe yourself out. And in fact, with our type of programs, if you do 3 trades in a row that hit the max allowable risk to your portfolio, we tell you to stop what you're doing and go back to a paper trading account, because it's not the market, it's you. It's not the market giving you curveballs. It's something you're doing, because you shouldn't be suffering that much. Okay. Take a look at this graph. This is a range-bound sideways channeling symbol. How about if we buy an underlying or we buy a call option trading at parity at one of its lows? We'll put a stop loss order in place. We'll sell that near-term call option, and at the same time, while the position is going our way in a time of peace, we'll buy a 3 to 6 month out put option as a collar. We'll make that put strike price near this stop loss order down at the bottom. That near-term call will expire worthless for us. We'll sell back that put option at the next bottom, and we'll rinse and repeat. Or if the next move coming to us is a reversal at the top of the channel, we'll do the same thing but backwards. We'll either short an underlying symbol, or even better, buy a put option trading at parity. We'll put a buy to close order up here, almost like a stop loss order. We'll sell our near-term put option at the next reversal. And at the same time, while things are going our way, we will buy a 3 to 6 month out call option. We'll collar it. We'll marry our protective option. The near-term call will expire worthless. We'll sell that back 3 to 6 month out call option out, and we'll just rinse and repeat, rinse and repeat. So you'll notice here, if you look at the time period, we're doing maybe 3 transactions a month per position. This is a great way to generate income, but what happens if we either blast to the top side or to the bottom side? Well, let's go through it. But before I do that, let me just ask, do you guys know who the heck I am? Have you ever heard of me before? By the way, the chat box is open if you want to type something in. Let me just take about 5 seconds to go over who I am. I'm a founder of a company called Trading Trainer. People like to recognize me as one of the world's most disciplined options trader. I think behind my back, they like to call me the world's most, if you will, lazy options trader. I like to think of myself as a efficient options trader. That's because I like to take the least amount of energy, least amount of my money, least amount of effort to make the most amount of profit and expose myself to the least amount of risk. So I'm not trying to go out there to be a day trader or anything like that. I just like to get a nice income rolling in, and I like to be protected when the market goes against me. Been an active equities and options trader since 1997. I started Trading Trainer in 2002, publishing my daily insights for them every night, 5 days a week. I've got an ebook out there that I published that's now coming on its 15th year of being released. Also, we've got a home study course you might have seen on people's shelves. But the most important thing that I like is that I've got a foundation that I run in parallel. It's a nonprofit, and I take inner city gangbangers off of the street. I teach them how to invest. I started that also in 2003 outside of Denver in a kind of rough neighborhood of Aurora, Colorado. Took 9 of these kids. We didn't have access to high-speed internet connections. In fact, high speed back then was called a DSL connection. They didn't even have computers, so we had to go to the public library there, where they limited us to just 30 minutes per day. Now, these kids were getting ready. They were in high school, getting ready to graduate. Are you guys not seeing? Somebody is saying that we're not seeing my slides. Can you guys verify that my slides are updating here?
Yeah, I'm seeing the foundation
Perfect.
slide still.
Perfect. Thank you. Thank you. Thank you. Just wanted to check it out. So keeping going there. The Investing Turtles experiment. I'll tell you that those kids, even though they were getting ready to graduate high school, they pretty much did not have more than a 4th grade education. And this was a perfect example of having people pushed through the school system just to get them off the rolls. But we took these kids with their 4th grade education, and at the end of 6 months of working with them a half an hour a day in the public library, I actually gave each one of these kids $2,000 of my own dollars, thinking I'd never see that money again. And I'll have you know that every single one of those kids, they're all now grown men, they gave me back that money. Plus, most of them bought their own computers and bought their own internet connections. One of them put themselves through Denver University, now has a background in finance. I'm just very proud. Anyway, we've been doing this foundation every year. Since then, we have moved it from Colorado to Southside inner city Chicago. Last year, we graduated 170 kids from our program. So very happy about this program. And this is what I do this for. Okay, take this quick quiz. Many of you have probably seen this or been asked to take this quiz before, but I want you to go through it with me again. Would you take $50,000 right now? Or would you take a penny that doubles every day for a month? Let's go through the math. So after the first week, I've got 64 cents. I'm kind of worried because I'm about a 1/4 of the way through the month, and I don't have anywhere near the $50,000. Okay, I'm in day 10. I have $5.12 to my name. Still, I'm still not anywhere near that $50,000. I'm already a third through the month, so I'm starting to get kind of sweaty on my brow. Okay, we'll get to the halfway mark. The halfway mark, I have $163, still nowhere near the $50,000. I've been putting in all this effort to double that penny every day. I should have just taken the $50,000, but let's see what happens. Hey, I'm at 3 weeks in, 21 days, getting there, $10,485.76. But again, I've been putting in the effort for almost 3/4 of the month, and I still cannot seem to get anywhere near the 50,000. But look what happens as we get towards the end. I'm at day 24. I'm about 2/3 of the way through the month, a little bit more, and I'm at $83,886.08. I finally have passed that $50,000, and that last few days of the month brings me all the way up to $21,474,836.48. And that's just a perfect example. I'm not sure if this is actually attributed to Albert Einstein, but this quote says it is. Compound interest is the most powerful force in the universe. So how can we use that in our investment? Please write this down. If we reverse engineer it, and we don't want to double our penny every day, what if we just want to double our portfolio every year? In that case, just with simple compounding, not continuous compounding, but if we just compound 6% every month for a year, then our investment will double. Okay? So instead of shooting, I know a lot of people have been talking about doubling your money or making 200% ROI. Let's focus on 6% per month. All right, so if we did that and we put $1,000 in, $2,012 in 12 months, or $4,048 in 2 years. In 5 years, I'd have $32,987. In 10 years, I'd be a bona fide millionaire, $1,088,187. But what I like even better is if I grow my portfolio to $100,000, or if I start with a portfolio at $100,000, this means I could be focusing on generating $101,219.65 per year. That's more than the average white-collar salaried position. And this is letting my money work for me, being an investor, versus putting in 60 hours a week, which is what that $87,000 a year job comes with, a 60-hour-a-week job. So I like this a lot. I like being able to generate this income off of my portfolio. So let's just take a quick quiz so that I make sure you got that down. What minimum returns must you make monthly on your portfolio if you want to double your money annually? If you selected D, 6%, you're spot on. So what is it that we're investing in to make 6% per month? We're selling theta decay optimized option premium. We like to shorten that and just say we're selling option premium. We profit on time passing by. And this is really nice because, as you know, there's a lot of variables out there in the market. If the Fed stops buying junk bonds, or if there's any sort, the market may drop directionally. It may go up directionally. There's a lot of implied volatility plays, but you have to be spot on. But time is something that just keeps passing by. In fact, if 60 seconds doesn't equal a minute, and a minute doesn't equal 60 minutes doesn't equal an hour, and 24 hours a day, if all of a sudden that starts going haywire the way that the markets have been going haywire directionally, we've got something more to worry about than just investing our money. Would you agree? So we like to profit on the fact that options have a wasting asset, and if we sell that option, it's going to wind up expiring worthless. That's one thing, they always talk about how death and taxes are the two things you can count on. Well, as an option trader, a third thing you can count on is that option premium will always be 0 at expiration. So you might be saying, okay, you keep talking about this option premium. If you look up an option price on the big board, on the CBOE board or on the NASDAQ, you'll know that that option price is equal to 2 components. We call that the in-the-money value and the premium value. If we've got some academics out there, in-the-money value is the same as intrinsic. Premium value is the same of extrinsic. Some people call the premium or extrinsic value time value. I kind of have that as a pet peeve because there's a lot more into that premium than just time. So I call it premium value. So I just want to make sure we're on the same verbiage. Please make sure you've got this in your notes. Some of you are probably saying, hey, I'm on this options call, but I still don't have a good idea what an option is. It's a financial instrument. We call it a derivative. They're typically bought and sold to hedge risk against things like stocks, indexes, exchange traded funds. But of course, again, that's not how we're using them here. We're instead selling them for their premiums. So how do you sell premium? Well, we're going to focus on 4 simple transactions. Get your pencil or pen ready. We like to write covered calls, or we like to flip that covered call upside down. We like to write covered puts, or we like to write covered calls against leaps. This is like my supercharged covered call writing strategy. For, again, you academics out there, we like to call that a bull call diagonal debit spread, a specific variety of such. And we also like to write our covered puts against leaps. Now, something you should know about these 4 strategies, these 3, the writing the covered calls, the writing covered calls against leaps, the writing the covered puts against leaps, they're all cash trades. Why do we care if they're cash trades? It's because I like to do this strategy in my Roth IRAs and my Roth SEP plans, right? You can definitely do a cash transaction. These transactions can be done in tax-free or even tax-deferred accounts. If you're not in a tax-free account, you should get all your money transferred over, because tax-deferred accounts are all about you not making any money on your money. And who wants to be in that position? Get into your Roths. Side note. The writing the covered puts requires a margin account. So just know that. But we do have a strategy that has the same pattern that could apply to the writing the covered puts, and that's the writing the covered put against leaps. So we always have a backup if you are going to be doing this and focusing on a cash trade. Keep that in mind. So let's take an example. $6.27 for GE. That was yesterday's closing price. 17 cents if we want to sell the June 19th call. That means we'd get an instant dividend. I like to call it an instant dividend of $17 per option contract sold. Most of you know that options come in lots of 100. There's a few examples where maybe it's different than 100, but 99% of the time we've got 100 shares of options per contract. So we just made an instant dividend of $17. Now that call is going to act as kind of like a coupon, right? You know that you get those coupons in the mail, and those coupons, if you use them before they expire, they give you a discount. You're basically the buyer of that coupon. But the seller, the stores, they really don't want you to use that coupon. They want to give you that coupon so that they get you to come in the store, but they'd rather you bring it in after it's expired so they don't have to pay out on that. Well, that's what we're doing here. We're selling these coupons, and then if they use them, that's one thing, but if they don't use them, then we get to keep the money and we get to sell another coupon next month, right? We also wind up getting a nice discount on GE, right? The going price is $6.27, but because I sold that coupon, I basically am in it for just $6.10. So let's go through the scenarios. If GE closes above $7 on June 19th, what happens? Well, okay, $6.27 is what I'm out for buying GE. I get $7 because I got exercised. So I make 73 cents per share. Then I make the 17 cents for having sold that premium. So I make a total profit of 90 cents. A total profit of 90 cents, that gives me a 14.8% ROI. What if GE is flat by June 19th? All right, so I buy some General Electric at $6.27. I sell the premium for 17 cents. I get to keep 17 cents. I've got 2.8. By the way, let me tell you one more thing about GE. So I'm going to bring over my Thinkorswim. I might have to change what I'm sharing. Give me 1 second. Here it comes. So here's my Thinkorswim. And you can see here on GE, GE is not one of the best stocks out there. I wanted to use GE because it's a very straightforward example. And I'm showing you the worst case scenario here, which is called a buy right, just for this lesson. But there are much better stocks out there to do, and I can show you where we can find those stocks in a little bit. So I wanted to let you know that GE right now, this example that I'm showing you from yesterday, is one of our worst case examples. But even as a worst case example, it seems not to be so gosh darn bad, right? If we get exercised, like I said, we'd wind up with 14.8%. If we don't get exercised, well, we get to have 2.8% ROI, and we get to do it again and again and again. What if it drops by June 19th? Now, I'm going to show you a way to ensure these things. But built into the strategy, you can see that we have a profit buffer of 17 cents. The break-even price, we can have this thing drop all the way down to $6.10, and we're still in the red. I mean, in the black. We're still doing well. Okay, so that's all right. By the way, here are some gains that we've made. I'm not going to spend much time on them because I'm looking at the clock, and I want to make sure I cover everything for you. So 17% on Micron in 12 trading days, 15% on Activision when the stock treaded water, 14% on Allscripts when the stock took a big old dump. So just to make sure that we're all on the same page, little quiz. What does investing by selling premium create? And now you can answer 1, 2, 3, 4 of these answers. Answer all of them that apply. What do you think is the correct answer? There might be more than one, is what I'm saying. If you're thinking all of them, you're spot on. It's an instant dividend. At the same time, it's a profit buffer. It acts as an expiring coupon, and it lets us discount the price that we're going to pay on our security. Okay, a couple more gains. 21% on Caesars when its stock went up. 12% on St. Joe when the stock went sideways. 17% on Community Health when the stock took a big old dookie. Okay, now I'm going to ask you the question in advance. How can we lower our investment and at the same time increase our returns and even convert a margin trade into a cash trade? Should we sell out in time options? Should we replace the security with options that are trading at parity? Should we give up and buy mutual funds, or is what I'm talking about not even impossible? What do you think? A, B, C, or D? Now, this one only has one answer. Kathy's got it. Carl's got it. People are typing in the answer. The answer is, let's replace the security with some options trading at parity. So option premium is the most when the option is at the money. In other words, option premium, remember that means extrinsic value, time value, even though the time value name makes me cringe. Option premium is the most when the option is at the money. But when we go deep enough in the money, the option has very little premium, and we like to target less than 5%. And it's almost completely intrinsic or in the money value. In other words, if we go deep in the money, the option behaves exactly like the underlying security, dollar for dollar, only at a cheaper price. So what is this that I'm describing? I'm describing options trading at parity. So options trading at parity, we do that by going deep in the money. We target less than 5% premium value. We get a dollar for dollar comparison to the underlying symbol. So then the question might be, say, okay, I'll go deep in the money, but how far out in time should I go with this substitute option? We go far enough out in time so that the substitute option expiration will not interfere with selling many cycles of premium. Now, right now, in the last 3 months, we've been selling 3 to 4 months of premium before getting either bailed out or exercised. Before all this shenanigans happened, they were going 5, 6, 7 months. So what we like to target is going at least 6 months out in time, if not more. Write that down. And we typically like to use option leaps. Why? Because leaps have a lot of liquidity. And liquidity is never a bad thing to have when you're out there option trading. So we want to go out at least 6 months, if not more, using option leaps, going deep in the money. So let's go through that same example. So I could take my GE, which last night traded at $6.27, or I could substitute it with a deep in the money call. In this case, it was the $2 call, and pay about 2/3 of it. Instead of paying $6.27, I'm only paying $4.37. This example is 98% intrinsic or in the money value, 2% premium. So it is, for all intents and purposes, trading at parity. So, okay, I'm going to use this back month option instead of the underlying symbol, pay $4.37. I'm going to collect my 17 cents for selling the near term at the money option, get my instant dividend of $17. So let's go through the scenarios. What if we go above $7 on June 19th? $4.37. I make $5. Don't forget, if I get exercised, I have to exercise the $2 call, so I get to keep the difference, the spread. So 7 and 2 gives me $5. So I make 63 cents of profit there. I made 17 cents of profit for selling the call in the first place, so I get 80 cents, or my profit just jumped up to 19% ROI. On the underlying symbol, the profit, if you remember, was what? Around 14%. So I just hiked up my ROI on this ho-hum trade of GE, and I paid less money to get into it. But what happens if GE is flat? All right, I bought this back month option. I get this 17 cents. I keep the 17 cents and I do it again and again and again. I've bumped up even on this ho-hum trade. We're now at 4% ROI, getting close to that 6% number, right? What if GE drops by June 19th? Same thing. I've got that price buffer of 17 cents. 17 cents per option sold. $4.20 break-even price. But okay, we want to protect it for what happened a few weeks ago, a few months ago, when the market really went into the toilet, don't we? Let's get past some of these gains. 43% on Yandex, 9% on Guess Jeans, 2% on Bloomin' Brands when the stock went down. So how can we drastically reduce our return on risk? Should we sell half as much as the option premium? What about selling some out-in-time options? Will that help? What about collaring the investment by marrying a protective option? Or is what I'm talking about not possible? What do you think? Let's collar the investment by marrying a protective option. Let me show you an example. I've got actually 2 examples of some real-life trades. I'm going to show you the first example right here. This is of Ericsson. Let me go ahead and make sure I'm sharing the correct screen. Give me 1 second. I want to share here. This is my spreadsheet where I keep track of my trades. So this is a trade I did on Ericsson. So I went ahead, and Ericsson, as you know, you may not know, likes to go up and down in a channel. So I leg into these positions. I try to get the best price, whether I'm at the top or the bottom. So the first thing I did was I purchased some Ericsson shares for $8.30 each. You can see here the cost basis was $8.31 because it's factoring in how much I pay on commissions. I then sold my Ericsson premium for 20 cents. And I bought my protective put option for 5 cents. What happened as time went on? Well, the 20 cents wound up expiring worthless, so I wound up getting to keep the 20 cents. And the put, when I sold it at the bottom of the channel, after it was no longer necessary, I no longer needed to protect the premium trade, I got to sell it back for 25 cents. So I made 20 cents on the premium, and I made 20 cents on selling the protective option back. So think about that for those of you that are experienced traders. I'm not just using a sunk cost on a married collared protective option. I'm actually turning this into a profit center for the economics of the trade. I made two 20-cent components. In fact, look what happened. The cost basis now, every time I make 20 cents, gets lowered. I'm at $7.93. I did it again the next month, 25 cents for premium, 20 cents for selling the option. I'm sorry, 20 cents for selling the premium, 20 cents it cost me. This time I didn't get as good a deal of buying the protective option. The 20 cents expired worthless, and I got to sell my protective put for 25 cents. In this case, I only made a nickel on the selling back the protective put, but I made 20 cents on selling the premium. So in that case, I made 25 cents instead of 40 cents. I still made money every week, every month. And I did it again until I get exercised out. Wound up after just 2.5 months making 23.9% ROI. The cool thing about this as well, though, is after that first month, you'll notice that my cost basis was at $7.93, much less than the $8 that I was protecting it. And every time it gets lower, what does it mean? Keep this in the back of your mind. What does it mean when the cost basis, how much we have invested, is less than what you're insuring the position for? Think about that. Here's one that I just did in February. I bought some more Ericsson. I sold that premium. I bought it for $8.10. I sold the premium for 30 cents. I bought myself my protective put option for 15 cents. Remember, we like to adjust our positions in times of peace. So what happened? The market crashed on us with the whole COVID-19 pandemic. I got to keep that premium, that 30 cents premium, because obviously nobody was going to call me out with the price of Ericsson dropping. I got stopped out of Ericsson at $7.40, but my protective put kept profiting until it hit a bottom when I sold it at $1.95. Despite Ericsson dropping so much from the price I bought it to the price I got stopped out, you'll notice I still, and you'll notice as well, for those of you wondering what about the fees, you'll notice every one of these transactions is factoring in how much commissions I paid. So this is after commissions are paid. I made 17.2%, even though the market took a big dookie about 6 or 7 weeks ago, right? Not bad. Okay, so let's get back to the presentation. Make sure I'm sharing the right screen here. Give me 1 second. I think you're seeing my slides. Get past these examples. So I want you to look at this cool curve, because this is the actual Ericsson trade that I was showing you. And I want you to notice that there's a range high and a range low. The gray line is a range low. And you'll notice that here is the 0 break-even mark. So at the 0 break-even mark, you'll notice that soon between this 1 and this 2, these actually signify cycles or months in this case, the range low becomes greater than 0. And you'll notice as well that this is not a linear game, but the longer that I'm in these positions selling premium, because I'm reducing my cost basis, you'll notice that my gains are actually exponential. And we talked about how the gains go from 4 to 5 months, but sometimes they go 6, 7. Last September, I had one that went 11 months. You'll notice that around month 5, 6, who cares whether the underlying symbol goes against you and bails you out or goes for you and you get exercise, because the difference between the payout of having the position go against you or for you is about the same. In this case, about 85% ROI. So we really like these premium selling positions. We like them because we collar them, we protect them. Even when the market goes against us, we get exercised or we get bailed out at a profit. But the longer we stay in these positions, these range-bound positions, our profits accrue exponentially. We like that even more. So I asked you to think about what happens when our cost basis, our break-even price, is less than our protective bailout price. Is that called a risk-free investment? Is that called a losing trade? Is it called too much complexity, or is it called a pipe dream? What do you think? Spice has it. I'm looking over at the chat board. I'm looking at who's answering here. Kathy's got it again. Kathy's been getting all of the answers right. It's a risk-free investment. Karen, you got it right too. So very quickly, these positions become risk-free, usually within month 1 or 2. That means you've got none of your own money on the table. If it goes against you, that's fine, because you're going to wind up getting paid if it goes against you, or you're going to get paid if it goes for you. And if it just stays sideways, you're just going to keep collecting premiums. So let's review the 3 steps. Are you ready? Got your pencil, pen? We're going to buy or short an underlying security, or even better, we're going to buy a substitute option trading at parity. Step 2, we're going to sell a near-term at-the-money option for its premium value. We're going to collect an instant dividend and a profit buffer. Step 3, we're going to collar when things are going our way at the same time as we do step 2. We're going to collar with a married option that's at least 1 month out, and I'd prefer for you to go even further out, especially right now. Go 3 to 6 months out. Let's go ahead. While I'm here, I'm going to cross this one, and I want you to go 3 to 6 months out. That way, IV won't have as big effect on you and things like that. In expiration to protect your investment. Let's look at those steps in play one more time. So we could buy an underlying, or we can buy a call option trading at parity. That's if we've got a bottom coming up. We're going to put a stop loss order in place right then and there. At the next reversal, we'll sell our near-term call option. We'll buy 3 to 6 month out put option. The near-term call options will expire worthless, and we'll sell back our put option at the bottom, adding to the economics of our trade. If the trade goes against us like it did last time, guess what happens? We get stopped out of our premium position, just like I did on Ericsson. And at the next reversal, no matter how low it gets, we sell back that put, and that put is going to pay us royally. And that's what happened for a lot of us that have been doing these type of trades. However, if you didn't have this protective option in place because you were waiting or you were too cheap to buy it or whatever reason, and you tried to add it here, adjusting your position in times of war, that's a mistake to avoid. Now, again, what if you look at the stock that you're interested in, and instead of a bottom forming, it's about to form a top? then we're going to short our underlying. Or if we want to do a cash trade, we're going to buy a put, trading at parity. We're going to put a buy to close stop loss order in place. At the next reversal, we'll sell our near-term put option, buy a 3 to 6 month out call option as protection. The near-term put option will expire worthless. We'll sell back that call option, and we'll just rinse and repeat as many times as we can. Like I said, right now, 3, 4, 5 months is common that we just collect that rent. Here are some symbols. You might want to write this down. These are some symbols that came out of our screener. GE, Caterpillar, Zynga, Court, Oculus, EPC, Ericsson. I'll let you write those down. While you're writing those down, you might be saying, where are you getting those particular symbols that we should go look up? So people who have access to my program have access to my screener. This is my premium selling screener. I've actually spent years looking for ways to look at all the stocks, indexes, and ETFs out there and all of their respective option chains. Last night, this screener worked and it went through over 12,700 symbols. And when you factor in the option chains, that was over 1 million symbols that it went through, and it just looks for the best bets. And that's exactly what we did. I think you can see my screener. Maybe not. Let's make sure. Resume the share. Yep. There we go. I'm going to bring you back to my slide set here. So how would you like to, and I'm going to just spend 5 minutes pitching you, never miss a pick, minimize the amount of time you spend away from loved ones, have support whenever you need it to do this type of trading? Because that's what it's all about, right? Saving time, creating the clarity, and just getting the results, getting the job done. Now, I'm going to take a couple moments, tell you a little bit about my materials, my training and tools, and if they're right for you, that's fine. If not, that's okay as well. It's for someone who doesn't want to pay for all the data subscriptions that we pay for to find those picks for you. They want everything they need in one place. They don't want to miss any opportunities, want to spend more time doing other things. They don't want to do this alone. They want step-by-step instructions. This is for someone who wants to get consistent, reliable results. Here's an example for Charlene. I'm not going to spend too much time on Charlene, but Charlene had come to me. You can read right here. She was a teacher for 29 years. And teachers, by the way, I feel like are the most underappreciated group out there. She got sick, and she wrote this in the email that she sent me. You can see she was typing this out at 2:10 a.m. in the morning. She got sick. She actually got cancer. She didn't mention that. And she kept hanging on through all of her chemo treatments and got very weak. And finally, they ordered her out of the classroom. She still had 13 years left until she could get her pension. She thought she was about to pass away, and she actually had come to terms with it. And this is what sucks about, you know, some of these situations, but she had a miraculous recovery, and that should be good news. But then she was saddled with all these bills. She had no livable retirement coming in. She wasn't going to be able to collect for 10 years on her Social Security. So she got interested in the stock market. The rest is history. Thanks to AJ, I'll not only be making a living, I'll be able to travel. She uses our screener tool. She reads the daily table, finds the stock she's interested in, follows the strategy, and she recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration. So what do you get? You get a once-a-week webinar workshop. This is the workshop where we teach you how to create the plans that you're going to follow. and we have them all recorded. We give you a screener tool. In fact, I'm going to take a couple seconds here and show you what that screener tool looks like. Let's see if I can do this fast enough. Da, 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 da. Show all windows. Here it is. Share. Okay, so this is a screener tool. You can see you fill in the blanks. It's really straightforward. You fill in the blanks about what's the size of your portfolio, what's your max allowable risk, copy the numbers out from your trading software, whether you use Thinkorswim or whatever it is you do use. It doesn't matter. It's just copying and pasting bid and ask prices. And it comes up with you with those 4 different strategies, the exact plans, telling you how many shares you should trade, go long 400 shares. I mean, if you can follow these simple instructions, if you have a 4th grade education like my inner city kids do, you can follow these instructions. There's no way you can go wrong, right? All right, let me go back to my presentation. I know I'm getting a little bit less on time, and I want to make sure I give the next speaker plenty of time. So let me just finish out here. So we teach you how to fill out the worksheet from the picks that our screener finds. I already showed you the picks. Also, we like to support you. So we have a private messaging system where you can send us your plans, what you plan to trade and how you plan to trade it. Basically, send us the spreadsheet that you filled out, and we'll look over it and make sure, especially for your first couple of trades, make sure you're about to do something right versus wrong. So you send us those and we give you kind of the looks over. It'll either be me or somebody who's very experienced in trading. I like to look at every single person's plans. This program is so, I'm so confident in your results with it that I have this thing called a double your money back guarantee. Do the program for 6 whole months. And if you're not making a profit by the end of the 6 months, not only will I refund your money that you paid for the program, I will give you twice what you paid for your program up front. So I'll give you double your money back at the end of 6 months. Now, I do want you to commit to 6 months because I do want you to have me looking over your trades. I want you to, be confident in using the spreadsheet. You take the spreadsheet with you at the end of the 6 months. You can do it all on your own. It's nothing, no further purchases are necessary. So I guess you want to know what the URL is. So I want you to go right now, optioninvesting.org/special. Don't pass go. Do not collect $200. In fact, I'm going to show you. I have it on my screen right here. So I'm going to go ahead and show you because I followed that link before I got on this call with you. optioninvesting.org/special. And you should come to a page that looks like this. You can go on your mobile phones as well. It's works on mobile phones. It'll explain to you what you get exactly with the program. The program is $497 for 6 months. We also have a payment plan. If you don't want to pay $497 up front, you can split that payment up over 3 months. Again, make sure you read through the details because we have the double your money back guarantee. $497. You can pay with PayPal or with credit card. Let me bring us back to the presentation. And I think I'm just about complete, but I've got just to say goodbye to you guys. Let's see. I think you're seeing my presentation again. Realize that you deserve this. Your loved ones deserve this too. And if you have any sort of questions, you're welcome to reach out to me directly at aj@tradingtrainer.com or even give me a call. My number is right there. And I really appreciate you. I hope you learned something today. I hope you learned how to sell some premium, and I especially hope you learned some things to avoid.